Hi, welcome back to Financial Management. It's me, your teacher, Miss Maria Angelica Balatucan. For our lesson for today, we will be talking about financial planning and budgeting. So first, we will talk about financial planning. So there are several types of planning, but we will discuss the basic three types. So first we have the strategic plans. So strategic plans are usually for long-range plans. So they have the statements for the mission, corporate scope, corporate objectives, and strategies. So the mission statement is a statement of the firm's overall purpose. The corporate scope defines its line or lines of business and its geographic area of operations. The statement of corporate objectives sets forth specific goals or targets to help operating managers focus on the firm's primary objectives, while the corporate strategies are the broad approaches rather than the detailed plans and must be compatible with the firm's purpose, scope, and objectives. Next, we have the operating plans. So operating plans provide detailed implementation guidance to help the firm realize its strategic vision. So it can be developed for any time horizon, but most companies, they use a 5-year horizon, with a plan being quite detailed for the first year, but less and less specific for each succeeding year. And we have the financial plan, which is the focus of this lesson. It has 3 components. We have the sales forecast, the forecasted financial statements, and the methods for raising any needed external financing. So the sales forecast generally starts with a review of the sales in the past 5 or 10 years, and it begins with a look at the past growth, and it should take consideration the current conditions in both national and global economies, the firms and its competitors' new products, planned advertising programs, and so on. So now, let's go further and know about financial planning. So financial planning involves the making of projections of sales, income, and assets based on alternative production and marketing strategies, and then deciding how to meet the forecasted financial requirements. There are 5 basic steps in financial planning. First is we have to forecast the financial statements, determine the capital requirements, determine the sources of funds, establish a performance-based management system in order to reward performance and encourage management and its employees to be more productive and meet the company's objectives. And of course, we have the monitoring of the operations. Then we have budgeting. So a budget is a financial plan of the resources needed to carry out tasks and meet financial goals. So this is a plan that is translated into quantitative form. So the act of preparing a budget is of course called as budgeting, and the use of budgets to control a firm's activities is called budgetary control. Now let's move to the sample problems. Now let's try preparing the budgets. First, we have the purchase budget. We have here the given problem. Its requirement is a monthly purchasing schedule for March through July. So given here are the unit sales from March until August. Balian maintains inventory at budgeted sales needs for next month. So this means that Balian will have an inventory end equal to the sales for the next month. Given here is our March 1 inventory, which is 248,000 units. So how do we compute for each month's purchasing schedule? So you have here for March, we will begin with the current sales requirement. So remember that these are the sales for each month. So this is our current sales. We add the next month's sales. So why do we need to add? Because we need to maintain an ending inventory, which is equivalent to the next month's sales. And then we will deduct the beginning inventory, which is 248,000. So you will get 292 units. We will apply the same process for April. We will use the current sales. We add the next month's sales, which is our ending inventory. And then we deduct 260, which is our beginning inventory. Okay? So why is it that we deduct 260,000 as our beginning inventory? Remember, last month, we used this 260,000 as our ending inventory. And this is our beginning. So how come our beginning inventory is 260? Because our ending inventory in last month will become the beginning inventory in the current month. And our ending inventory in the current month will become the beginning inventory in the next month. Okay? So it's just a transition from end. If it's the previous end, then that's the current beginning. Okay? So 260,000 plus 250,000 minus 260,000, that's 250,000 units. Okay? The same process, current sales in units, current budgeted sales in units. And then our ending for this month, which is the budgeted sales for next month. And our beginning inventory is 250 because that was the ending inventory last month. The same process is being applied until July. Okay, so again, this is our current sales plus ending inventory minus beginning inventory. Now let's go to the production budget. So we have Superior Company with a single product. The requirements are the budgeted production for June, budgeted production for July, and the material purchases for June in pounds and pesos. So let's go to the details since we already know the requirements. So it keeps its inventory of finished goods at twice the coming month. So that means the next month, the coming month's budgeted sales. And inventory of raw materials at 150% of the coming month's budgeted production. Okay, so let's look again at the given. The finished goods inventory and should be twice next month's budgeted sales. Take note, this is sales. While the ending inventory of the raw materials will be 150% of the next month's budgeted production. Remember that the finished goods is different from the raw materials because the finished goods already has the raw materials, the labor, and the overhead, while raw materials only has the raw materials. It's not yet converted. Okay, and they have different base. So for the finished goods inventory and its sales, while for the raw materials and it should be budgeted production. So each product requires 5 pounds of materials, which cost 3 pesos per pound. The sales budget in units for May is 10,000, for June 12,400, for July 12,600, and for August we have 13,200. Okay, so for June, what will be our budgeted production? So we will begin with June's requirement. And what is June's requirement? So since we have the sales budget, this is what we need for June. We need 12,400 in terms of finished goods. So we will begin with the current sales requirement. Then we have here the finished goods inventory end. So the same with the previous problem that we solved, so we will need the end. Okay, and then we will deduct the beginning. So let's go back again to the solution. We'll start with the current sales requirement. We have 12,400. And then you have the next month's requirement, that is 12,600. Why is it 12,600, ma'am? Okay, so remember that sales is already the finished goods. We're going to sell that what is already done or completed. So remember that the inventory end is twice next month's budgeted sales. Okay, and what is the next month after June? So that is July. So twice of 12,600, that's the inventory end. And the same process in the purchases budget. Remember that we deducted the beginning inventory. And what would be our beginning inventory? Remember, our beginning inventory for the current month is the ending inventory of last month. So since we're in June, what would be our beginning inventory? The beginning inventory for June is the ending inventory in May. And what would be the ending inventory in May? So let's go back to the condition. It is twice the next month's budgeted sales. So the ending inventory for May is twice the budgeted sales for June. So what is twice of the budgeted sales in June? So that's 12,400 times 2. That's why it's 2 times 12,400. Okay, so you will get 12,800 units. How about for July? So the same process. We get the current sales requirement. So that's 12,600. And remember, twice the next month's budgeted sales. So the next month's budgeted sales is 13,200. So times 2. And for our beginning inventory, that's twice of 12,600, because the beginning inventory for July is the ending inventory in June, and to get the ending inventory in June we have to double the budgeted sales of next month. So that's 2 times 12,600. Okay, so for the third requirement, for the budgeted materials purchases for June, we will be needing the information on the budgeted production. So how many units are we going to produce? So here is our solution. So for this month, our current requirement for the June production is 12,800. However, since we have our rate that for every finished good, there should be 5 pounds of materials. So 12,800 times 5 pounds. The total pounds that will be used would be 64,000. However, we need to leave an ending inventory for this month. And what is our ending inventory requirement for raw materials? That's 150% of the next month's budgeted production. And what is next month's budgeted production? It's 13,800. So 150% of 13,800 multiply by 5, since every 1 unit needs 5 materials, 5 pounds of materials, you will get 103,500. So as you have observed in our previous examples, we will add the ending inventory and we will deduct the beginning inventory. Next is determine the beginning inventory. Remember that the beginning inventory is the ending inventory of last month. And what would have been the ending inventory last month? Remember, that is computed as the last month's ending inventory. So how do we arrive with the ending inventory of last month? So that's the June budgeted production. Okay, so that would be 12,800. So 12,800 times 150% times 5 pounds, you will get 96,000. Okay, so we just have to be careful with the amounts that we're going to multiply. Let us analyze properly the requirement of the problem. Remember that the ending inventory for raw materials is the 150% of the next month. Okay, and our ending inventory for the current month, that is the beginning inventory of next month. Okay, so sorry for the handwriting. I cannot write properly. Okay, it's okay. Again, the ending inventory for the current month, that is the beginning inventory of the next month. And our beginning inventory of the current month was the ending inventory of the previous month. So that's how we will be applying this concept here. Okay, so that's why our beginning inventory for this month, that is the ending inventory of last month. So that would be 12,800. Then since the costing is 3 pesos per pound, so we multiply 71,500 times 3. You will get 214,500. This is in peso. If we're asked how much is the budgeted materials purchases in units or in pounds, the answer is 71,500. So if we're asked how about the materials purchases in peso, the answer is 214,500. Next is, let's try to prepare a budgeted income, inventory, and purchases. Okay, so ironwood sells a single product for 10 peso. And here are the requirements: budgeted income for February and March, budgeted inventory at March in units and peso, and for March in terms of purchases, units and peso. Okay, so for the budgeted income, let's look at the details of the problem. So the purchase cost is 4 pesos per unit. The ironwood pays a 20% sales commission. Then we have fixed costs. So what are fixed costs? So these are costs that do not change even if your production is high or your production is low. They remain the same regardless of the number of units being produced. So these are constant. So if your total cost is 100,000 for this month, even if your production is high or low, 100,000 will still be the same. It will not increase, it will not decrease. Just like the salary of the president of the company. So even if the sales will exceed the target, so the same salary will be received. Okay, except for bonus, which will be dependent on the conditions or the standard of the company. Bonuses are variable because they are dependent on a certain base. Okay, so let's continue. The fixed costs are 45,000 per month, which includes the 12,000 depreciation, and the company maintains inventory equal to the budgeted sales needs for the following month. So the following budgeted data are available. Inventory on hand, so that's the beginning inventory, 28,000 units. Budgeted sales for February is 24,000, March is 26,000, and for April we have 25,000 units. Okay. So let's start with our sales. So we have 24,000 because that's our budgeted sales for February. Then we add 26,000. Okay. Because that is for February and March. Okay. So that's why 24,000 and 26,000. Then remember, these are units, so we need to multiply that with our peso selling price. So that's 10 pesos. So total amount is 500,000. Next is you multiply the cost of sale. So you get the cost of sale, sorry. So the cost of sales would be 50,000, which is the sum of 24 and 26 times 4 peso. Where do we get the 4 peso here? That's the cost. So the total cost of sales for February and March is 200,000. Gross profit is the difference between 500,000 and 200,000. So deduct. So we will get 300,000. Our commission is 20%. 20% of what? 20% of our sales, since this is a sales commission. So 20% of 500,000 is 100,000, sorry. Our contribution margin, that would be 300 minus 100, that's 200,000. Our fixed cost is twice, okay, twice the 45,000 monthly fixed cost. Remember here that we have 45,000 per month fixed cost. So since we're talking about the expenses for February and March, so times 2. So that is 90,000. Again, this is not always the case that you're going to multiply it by 2. It depends on the requirement of the problem. Since we are asked to compute for 2 months, February and March, that's why we need to double the fixed cost. So the income would be 110,000 pesos. Okay, B, find the budgeted inventory at March 31 in units and in pesos. Okay. So our budgeted inventory is 100,000. Okay. Let's go back to the information. The company maintains inventory equal to the budgeted sales needs for the following month. Remember, we're talking about March 31. Here is March 31, but the inventory is equal to next month's budget sales. Next month is April. The budgeted sales is 25,000. So equal. So the same. So 25,000. Since we're talking about the inventory in units, and in pesos. So the answer for the units is 25,000 units, and for the peso, we multiply it by 4. Why is it multiplied by 4? Because we need to get the costing. Okay, so that's 4 pesos times 25,000, that's 100,000. Now for letter C. Okay, so the third one is the budgeted purchases for March in units and in peso. Okay, so how do we compute? Okay, remember that for March, our budgeted sales is 26,000 units. Okay, and how do we get 104? So that's just multiplying 26,000 units by the cost, which is, remember, that is 4 pesos. Next, the ending inventory, as we know, we are going to add that, and then the beginning inventory is deducted. So 26 plus 25. Why is it 25,000 again? Because the ending inventory for this month is the budgeted sales for the following month, and the following month is April, which has 25,000 units. So 26 plus 25, it's 51,000. Again, all of these are being multiplied by 4. And then beginning inventory. So the beginning inventory for this month is the ending inventory of last month. Remember that in computing our ending inventory, we'll look at the next month's sales. So the next month's sales, if we're talking about February, that's March sales. So therefore, the ending inventory in February is 26,000, and we carry over the ending inventory to March. So the beginning inventory in March is 26,000. Okay, deduct 51. Then, sorry, deduct 26,000 from 51,000, so you will get 25,000 units, and multiply by 4. Our needed purchases is 100,000. If you're going to ask, why is it the same answer with the previous one? Since this is reselling, okay, if you can observe, we have here, they do not have any given for the conversion. Most likely, the purchases would be the same as the inventory end. And remember that the inventory end is equal to the next month's sales. These are not multiplied by 2 or multiplied by 3 and so on. It's the same number of goods. So most likely you will arrive with the same budgeted inventory and for the purchases. Unless this is a production of a new good, which will require different set of raw materials to be purchased and integrated into the finished goods. Okay, so that is the end of today's lesson. See you in our next video.